Latest Bloomberg Opinion piece, former New York Fed President Bill Dudley writes that tariffs on Canada and Mexico will deeply damage an economic ecosystem that has helped the U.S. remain globally competitive. Bill Dudley joins us now with more. Bill, we really appreciate your time today. Do you feel like the effect will be felt more on the inflation side or the growth side?
Well, first of all, we don't know what's going to happen, but assuming the tariffs are enacted in full, say a month from now, the effects are going to be both sides. We're going to have higher prices and lower growth because everything's going to be more expensive. And also, the tariffs are going to disrupt supply chains, so that's also going to lower productivity growth. The key thing about which one predominates, prices or growth, is whether the increase in the price level caused by the tariffs gets into people's views of inflation on an ongoing basis. Mm-hmm. If inflation expectations stay well anchored, like they did in 2017, 18, and 19, then the Fed can look through that increase in the price level and focus on growth. Mm-hmm. But if the price level increase gets into inflation expectations, then that's a much more difficult situation. And the situation is obviously different now than it was back in 2018 and 19, because then inflation was running below the Fed's 2% objective. We've been running above the Fed's 2% objective now for over 4 years.
And that brings me to something we brought up earlier in the show, is that 2-year inflation break even. That has been rising since the election. So if I'm looking at that just around 3%, and you were still at the Fed, how would you be understanding that?
Well, I'd be trying to figure out if this is a one-time blip or something that's going to last a lot longer. There are also measures of inflation expectations that look at long-term inflation expectations. For example, you can look at the spread between TIPS and nominal Treasury securities and calculate the inflation expectations 5 years from 5 years to 10 years forward, and that really hasn't moved very much. So that's the one that the Fed's going to be focusing on, is really the long-term inflation expectations rather than the short-term. To the extent that tariffs are going up, we know that prices are going to go up in the short term.
Is there sort of a case, though, to be made when we talk about what Trump is doing, or at least what he's publicly said he's doing, that it can balance out? And I asked that in the context that he was kind of asked specifically about the economic impact and asked specifically about the market impact. And he seemed to suggest that the issues that he says he's trying to resolve are also having an economic drag. And he's basically trying to find a balance in between the two.
Well, I suppose you could make that argument, but I mean, in the case of the 25% across the board tariffs put on Canada, what did Canada do to deserve that? There's not a lot of illegal immigration from Canada into the U.S., and the amount of fentanyl that seems to be coming across the Canadian border into the United States is de minimis. So that seemed more of an excuse to hit Canada with a 25% tariff. I mean, I think the big problem with 25% tariffs on Canada and Mexico is they're part of an integrated economic trade zone. The onshoring, friendshoring that's been taking place over the last 10 years has really integrated the Canadian and Mexican economy with the U.S. economy. If you all of a sudden you put 25% tariffs in place, you're blowing up that economic integration, which has actually had quite a few benefits for the United States.
Well, yeah, I mean, let's face it, with these 25% tariffs, I mean, Trump is effectively ripping up his own U.S. North American trade deal, which, of course, he ripped up the previous one prior to that. From an economist standpoint, and specifically from a Fed economist standpoint, we've heard from several members over the last few days, Daly, Bostic, Collins, and I think a couple others, who've kind of made it clear that they are just going to wait and see, that they really want to see the whites of the eyes of inflation before they react. And I'm going to put this delicately, but is there a case to be made for the Fed to be more proactive?
I think it makes sense for the Fed to wait and see for two reasons. Number one, they think that policy currently is restrictive, so waiting and seeing is at a restrictive setting. So that's also exerting some downward restraint on inflation. And two, we can just see how quickly things that can change. I mean, in the last 48 hours, gone from 25% tariffs on Canada and Mexico going to be implemented immediately to a 1 month hold, and we'll see what happens when that time period expires in early March.
So how quickly can this pass through to the actual consumer and to those expectations in your history and studies?
pretty fast because, as soon as someone knows that the cost of the imports that they're bringing in are going to go up significantly, they're probably going to start raising the prices on the shelf, today because they know they're going to have to replace those goods with more expensive goods. So I think there's also going to be hoarding by consumers. I mean, if you know the price is going to go up in the future, you're going to try to buy today. That's also going to give more, pricing power to the person selling that product. So I think that it won't take very long for higher tariffs to get into higher prices.
All right, now I'm sure your favorite question. We're looking at about 34 basis points of cuts priced into WIRP here on the Bloomberg Terminal, World Implied Interest Rate Probability. We had Morgan Stanley just say, you know what, one cut this year, not two, and that's going to be in June. Does that make sense? We're looking at one cut now?
Yeah, I think that makes sense. I mean, I've been in the higher for longer camp for a number of years now. And, my thesis is that, the interest rates aren't really exerting that much restraint on the economy. The so-called R-star, the neutral real interest rate is higher than it was in the last decade. And we can see that by the fact that the economy is doing fine, even though monetary policy is seemingly restrictive. So I think, and with uncertainty particularly high, and the tariffs likely to push up prices, it seems like waiting is the right strategy from the Fed right now.
I do want to go back, Bill, to this idea of balance. And I want to sort of draw upon a column that you wrote, I think it was either last week or the week before, about some of Trump's economic policies. I mean, we kind of be remiss in pointing out we're only 2 weeks into this administration. There's a long laundry list of things that Trump said he wants to do, and this only appears to be part of it. We talk about tax cuts, which of course would have to go through Congress, extension of tax cuts, which would have to go through Congress, and other economic measures. And I do wonder if you see any potential upside to those policies, assuming that they do become reality, that could blunt the impact from an increase in tariffs.
Well, the thing that people point to is that Trump has said he's going to deregulate, and if the deregulation is done thoughtfully and carefully, that can obviously, reduce the costs for business and raise productivity. But figuring out what regulations to do without endangering people, that's more difficult. I mean, the regulations are there for a reason typically, and often the reason is a good reason. For example, think about drug safety. So that's the part of the story that I think gives people in the stock market the most positive feeling about. If they're deregulation, productivity growth will rise, profits will rise, and that'll support the stock market.
How much confidence do you have right now in the FOMC, not so much to make the right decision, but also, as we know, to maybe resist some of the pressure that they might be getting from the White House to make decisions that maybe would be otherwise against their own traditional policies?
Well, obviously, I think the Fed will do the best job it possibly can and will not be responding to political pressure one way or the other. They'll do what they think is appropriate to achieve their objectives of maximum sustainable employment in the context of their 2% inflation target. And that's what they're going to do. That's what they have done. That's what they've always done. That's what they'll do going forward. At times, it may look political in the sense that the president wants them to cut interest rates and the Fed doesn't do that. But it's not because the Federal Reserve is trying to be difficult with respect to the Trump administration. Yeah. If they don't cut rates, it's because they think it's not appropriate.
But there seems to be a much different complexion to Trump 2.0. We've been talking a lot on this network all day long about whatever the heck's been going on over at the Treasury Department with some of the guys, and they're all guys that Elon Musk sent over there to root out whatever the heck he wants to root out. We've seen other measures in some non-economic areas like USAID and a few others. Why am I to believe that the Fed would somehow be immune or safe from that?
Well, I think the Fed is going to come under scrutiny for, its expenditures. I think the Fed will come under scrutiny for whatever it's doing in terms of diversity, equity, and inclusion. So I think the Fed will, and I think as a result, the Fed will be very careful about how it proceeds in those kind of areas. I would expect the budget at the Federal Reserve is going to be very austere over the next few years. I think the issue, though, about what's happening at Treasury is a much bigger issue, which is Congress is the part of the government that makes the expenditure rules. Yeah. And it's not up to the president to decide whether that money appropriated by Congress gets spent or not. So I think this is going to go to the courts.